Imagine, it's Monday morning. You open your banking app to check your balance, and the first thing you see is that automatic car payment just hit $820, or $950, or maybe even $1,200. The day just started, and you're already down almost $1,000. And this isn't a one-time thing. This will happen every single month for the next 6, 7, or even 10 years. You try to calm yourself down. Well, I need a reliable car. It's safe for the family. It's worth it. But deep down, there's this nagging feeling that you don't actually own this car. It owns you. Hey everyone, I'm James. I spend way too much time thinking about money, debt traps, and why regular people end up paying double for something that loses half its value the moment they drive it off the lot. Today we're diving into the single most common, most expensive, and most quietly accepted financial trap in modern America. The car payment trap that almost nobody calls out by name. If you've ever felt like your car payment is quietly strangling your budget and your future, this video is for you. Smash that like button right now if you want to finally understand why this monthly hit feels like chains, and subscribe if you want more no BS breakdowns like this. Let's start with the numbers, because the numbers show just how massive this problem really is. In 2025, the average new car payment in the United States is now over $740 per month. For trucks and large SUVs, it easily hits $900 to $1,200. Meanwhile, the median take-home pay for American households is roughly $4,200 to $4,500 a month after taxes. That means 20 to 30% of a typical household's net income is going straight to one vehicle, and plenty of families have 2 or even 3 car payments. That can easily be more than their mortgage. But here's the crazy part. Most people don't feel broke when they sign the paperwork. They actually feel successful. And that's exactly where the deepest, sneakiest part of the trap begins. Part 1. How they make you think this is normal. When you walk into a dealership, the salesperson almost never says, "This truck is going to cost you $105,000 over the next 8 years." Instead, they say, "Just $989 a month." That's less than rent on a nice apartment downtown. You work hard. Don't you deserve something reliable? That shift in focus, from total cost to monthly payment, is the foundation of the entire modern auto industry. It's a psychological trick that works incredibly well. Our brains are terrible at judging large future sums. $989 feels manageable. $105,000 feels terrifying. Part 2. The main mechanisms of the trap. Let's break down exactly how the system keeps people overpaying for decades. Mechanism 1. Crazy long loan terms. Car loans used to be 36 to 48 months. Now the standard is 72, 84, and sometimes even 96 to 120 months. Why is this a trap? Because the longer the term, the more interest you pay, even if the rate looks reasonable. Example, $48,000 vehicle at 7% interest. 48 months, total interest approximately $5,800. 84 months, total interest approximately $11,200. Difference, more than $5,400 extra, just for stretching the payments. Mechanism 2. Negative equity, being underwater. The average new car loses 20 to 25% of its value in the first year and 50 to 60% in the first 3 years. If you put little or nothing down and finance for 6 to 7 years, you're almost certainly underwater within 12 to 18 months. You owe more than the car is worth. What do most people do? They trade it in and roll the negative equity into the new loan. $4,000 negative to $8,000 to $14,000. And the hole keeps growing. People literally end up making payments on cars they no longer own. Mechanism 3. 0% financing. The biggest illusion. The ads scream, 0% for 60 months. Sounds like free money. But almost always one of two things is true. A. The sticker price is inflated by $2,000 to $5,000 to pay for the 0%. B. You only get the real discount if you pay cash. 0% comes without the discount. There's no free lunch. Mechanism 4. All the add-ons they sneak in. A. GAP, insurance, usually marked up 2 to 3 times market price and rolled into the loan. Extended warranties for 7 to 10 years, $2,000 to $4,000. Theft protection, credit protection, paint and fabric protection, etc. All of it gets added to the loan balance and stretched over 84 months. Part 3. The real total cost of ownership, the number that hurts. Let's run the real numbers for an average new truck priced at $55,000 over 7 years. Loan payment, $800 per month times 84 months equals $67,200. Insurance, $280 per month times 84 equals $23,520. Fuel, 15 miles per gallon, 15,000 miles per year, $4.20 per gallon. Approximately $350 per month times 84 equals $29,400. Maintenance, tires, repairs, approximately $1,800 per year, times 7 equals $12,600. Registration, taxes, washes, approximately $4,200 over 7 years. Total approximately $136,920. And at the end of 7 years, that truck is worth maybe $12,000 to $15,000 on the used market. You spent $137,000 to be able to drive a vehicle now worth $13,000. Now compare. If you had put that same $800 per month into a simple S&P 500 index fund, averaging approximately 8% annual return, after 7 years, you'd have roughly $78,000 to $82,000, growing for you instead of disappearing. That's not just lost money, that's stolen future. Part 4. The psychological side of the trap. This is where it gets really interesting and really painful. 1. Identity tied to the vehicle. Decades of marketing have drilled this in. Your car is who you are. Big truck equals strong, successful, independent. Small, efficient car equals loser. Cheap, can't hang. 2. Automotive Stockholm Syndrome. People start defending their terrible financial decision with the same passion they defend their family. Yeah, the payment's high, but I'm not driving a beater. This is about family safety. I work hard. I deserve this. 3. Life narrowing. A big car payment quietly forces you to stay in a job you hate, skip career training or side hustles that could increase income, live in a cheaper area farther from opportunities, delay having kids, moving, or taking time off, pick up extra work just to cover gas and insurance. You voluntarily reduced your life options by 20 to 30% of your income. Part 5. How to actually escape. Realistic plan. 1. Stop comparing yourself to others. Most people with big car payments aren't richer than you. They're just deeper in the trap. 2. Buy reliable used cars with cash or very short loans, 36 to 48 months max. Best targets: 3 to 6-year-old Hondas, Toyotas, Mazdas, Subarus with clean history. 3. Set a strict price rule. Total cost of the vehicle, including taxes, fees, registration, should be no more than 50% of your annual take-home pay. Ideally, 30 to 35%. 4. Always calculate total cost of ownership, not just the monthly payment. Use online TCO calculators before you even test drive. 5. Build a future car fund. Start putting aside $150 to $300 a month specifically for your next vehicle, so you can eventually pay cash. It completely changes your psychology. Final thoughts. The car payment trap isn't really about cars. It's about how quietly and completely your freedom, your time, and your future get stolen. The scariest part. Most people never even realize they're trapped. They just get used to it. But the moment you see the system for what it is, you're already halfway out. If this video made you think even once, maybe I don't actually need a new car right now, then it did its job. Drop a comment. What's the biggest car payment you've ever seen from a friend, family member, or even yourself? And save this video. You might need it the next time you're standing in a dealership. Thanks for watching all the way through. Protect your money and protect your freedom. See you in the next one.